we've seen over the last couple of quarters, things have gotten very volatile in terms of tariff impact amongst others. Currently on the ground, are you seeing companies wait back on consumer discretionary spends and only do the necessary part in terms of giving out deals as of now as well?
Yeah, I think, thank you for having us. So on this issue of, top-down demand and discretionary spend, I think there's a bit of a transition underway, so to speak. What used to be the classical, run the business spend, and then on top of that, a discretionary bucket is kind of being replaced by what we are calling a straight line budget and funding those programs that come up for approval. So the decision cycles are based more on the program ROI, the ability for the stakeholders in the enterprise to actually get those programs funded. I think that's a direct correlation of two things. One, every enterprise is now looking at AI and saying, okay, where is my efficiency? We really don't need to add more headcount. We should find 20%, 25% efficiency through use of these tools. And second, it's not about blanket, here's your budget, go spend it. I think it's more about what's the value you're going to drive. We should find a way to justify that investment, whether it is cloud-driven, whether it is AI-driven, whether it is data-driven. And in a way, a number of enterprises are now focused on finding the money from within existing tech spends to be able to divert that to AI. So the focus on, finding efficiencies and savings, obviously that it was never important, but it's actually even more important now because every deal has to have an element of efficiency and savings in there.
So Mr. Rakesh, does that mean that the companies have actually for long not spent enough on AI, and now, despite a volatile environment, they don't actually have a choice but to at least start some incremental spending for their business to continue and grow, as well as get that benefit of an AI-led model?
In a way, yes, because remember, enterprises adopt technology once it becomes more mainstream. They're never, jumping into every new shiny object. It's been almost 3 years since the launch of, the first OpenAI Gen AI model that we all know as ChatGPT. I think the following 12, 18 months was all about understanding what it was, experimenting with it, setting up, use case factories and proof of concepts. And the last 12, 18 months have been really about incorporating that into their tech and operations. And I think we are still in the early phases of that. So in a way, I think there is a lot of pressure top down, board, C-suite, for every enterprise to have an AI strategy and have an implementable, set of actions that can be justified, not just for the hype, but more importantly for the impact that they're showing. So I think it's a given that almost every enterprise will continue to adopt it. Enterprises typically adopt new technologies once consumers adopt it. I think we've seen rapid adoption of ChatGPT by the consumers, and that's obviously making the technology more stable. There's a lot more feedback loops coming in, and they're all hardening their environments to be able to adopt it at scale.
And Mr. Rakesh, is that one of the key reasons that you've actually also seen a very incremental rise in deal wins, roughly 760 million in this quarter? When I even compare on a quarter-on-quarter and YOY basis, it's more than 100% on a YOY basis. So you've had some large deal wins in this particular quarter. Any particular common theme that you're seeing within them? Is this more some specific sectors like banking doing well, or do you see that what you just mentioned on AI-led model, that is one of the common themes between all these large deals?
Yeah, I think the AI-led model really is the common theme. And again, lead indicator of business performance is always the pipeline, and then turns into order book that turns into revenue. For the last couple of quarters, we saw an expansion in the pipeline because we were able to stitch together what we are calling the savings-led transformation thesis into a set of propositions that we can then, originate opportunities with, qualify them, shape them, turn them into deals, go to the customer through the cycle. Much of this has to be done proactively because you can't wait for RFPs, or opportunities that the client will bring to you. So I think it's the common theme really is around areas like, expanded cloud adoption, efficiency, cost takeout, using data and driving the right data platforms, application modernization, productivity from a dev and SDLC transformation perspective. So those are the common themes. It's pretty broad-based across sectors. It's not just one or two sectors. That's why you've seen 3 of our sectors have grown at 20+% YOY, out of the 5 segments that we report. So I think it's a pretty broad-based theme, and the common theme really is the ability to bundle AI into those propositions and create those ROI cases and the price to value cases that clients are looking for.
Mr. Vishwanath, let me come to you just on margins. With these strong deal wins, and the trend is quite higher compared to the last 3 to 4 quarters, where the deal wins largely operated between 300 to 400 million. So in terms of margins, do you see some kind of impact going forward because of the ramp up of these deal wins, or do you currently have the headcount available to start executing these new deal wins essentially over the next couple of quarters and don't see too much of an impact on margins because of headcount addition?
Yeah. So Puneet, so we delivered 15.3% margin, which was flat on a QOQ basis and an improvement on a YOY basis. So if you really look at it, we've been reasonably consistent on our margin performance, and we've got a stated range of operating between 14.75 to 15.75%. And I'm confident that we will be well within this range, right, as we'll go forward. Usually deals, as we scale up and accelerate growth, is a tailwind for margins. But there are also investments that we need to make, and Nitin kind of talked about it in terms of what we are doing in terms of big bets on AI. But in general, I think margins will be range bound within the guidance range that we are given.
And Mr. Rakesh, in terms of growth, in terms of revenue, what could be one of the key factors apart from deal wins that you look at is on the ground, and what gives you the confidence that this year could be one of the years better performance compared to what we saw in FY25?
I think there are 2 or 3 elements that go into it. One, obviously, you have to catch the right trends, expand in the right addressable markets, bundle deals together that give you the ability to potentially supersize the deals, and of course have a proposition that resonates with the customer, but also helps you make your stated margins. We also obviously have to stay very aware of what's going on with each customer. So this is more an account by account strategy, because every customer is at a different adoption cycle, at a different maturity curve, at a different tech stack, even within the same industry. So I think what we are really trying to do is run multiple motions around finding opportunities, creating those deals, while at the same time looking at what we're doing in those customers' accounts, and ensuring that we have the right positioning when it comes to protecting our existing business as well.
Mr. Rakesh, you did mention that sectors like banking and financial, insurance, as well as TMT did very well for you in this quarter. While on a lower base, logistics as a sector has not done very well, and it's been a sector where you've had some key comments over the last couple of quarters as well. Do you see that there could be some revival in quarter 2, or do you pencil in any kind of growth in this sector only in H2 of this year?
I think we are fairly optimistic that bulk of the declines in the sector are behind us, and we do expect that growth will gradually recover through the remainder of the year. Now, whether it is Q2 onwards or it's back-ended, I think we'll continue to evolve. And the reason we are saying that is, one, we know the source of declines was related to a certain specific customer and the investments we chose to make with that customer. But also the pipeline on that sector, more broadly, is fairly strong. And for us, travel and logistics is actually 3 or 4 subsegments inside of it. There's airlines, very strong demand, very strong pipeline. There is railroads, again, good demand and pipeline. There is logistics, and then there's supply chain. So I think the confidence is that we should be able to see revival in demand through the remainder of the year. The pace of demand the pace of revival will depend on how quickly we are able to close some of these deals.
Just one last question to both of you gentlemen, because and would love your views on this. We've seen from Y2K where coding-led model was the way to go, and we also saw a lot of micro as well as regional hubs created all around India because of the advent of coding and what it meant. So we've seen over the last 20 years drive the IT sector with that expertise of talent and recruiting talent and then training them in that aspect. But how do you see that changing with AI coming in? Because it's still a very developing technology. We've seen a few, you might find some talent that has a grip on what's happening right now in terms of development and get that kind of, expertise in that space. We've also seen some companies reward that specific talent as well, because you are not seeing that kind of at least boom as of now. For you specifically, how do you choose your ideal employee to say, in a sense, because we are seeing that the use of AI has now not an option anymore in terms of providing that efficiency. So what do you currently see in an ideal employee when hiring?
So I think we look for two core things. One, obviously, we're looking for foundational skills, right? For example, Java or .NET family of skills. Foundational skills are extremely important. The ability to design and develop software is important, but of course, not every job classification requires that capability. So any which ways we look for technical skills, and the second thing we look for is the learnability of the employee. And then I think as an industry, our whole sector has been pretty good about creating net new skills when none existed. Right? Good examples, you talked about Y2K, the whole internet era, client server technologies came about. Then we saw the digital revolution. We went from waterfall to agile, full stack came about. So I think we are able to create net new talent, whether it is multiple locations, multiple countries, multiple cities, tier 1, 2, 3, 4 cities. But I think the only other difference this time around is that the propositions require not just talent, but talent plus plus. And what I mean by that is you need good quality people. That's a table stake condition, but you also need the ability to stitch them together with good quality tech solutions. Because clients are now demanding that we show them how we are going to drive that efficiency. We show them the ability to orchestrate technology together with bringing the right people to the table. So in a way, we are transitioning further, going up the value chain and moving away from just people-based IT services to tech solutions-based IT services that include people.
And Mr. Vishnath, if you have any specific comments on this, as well as how would you be maintaining that kind of margin going forward because of this potential impact? Because the talent crunch, while not there right now, with the advent of this, could be one of the key factors to watch out for.
Well, I think one of the big bets we are doing is the platform play. Right? You talked about the neo platforms that we do, where you have digital workers kind of doing work. So I think AI is an evolving world. Obviously you need a different scale of talent, but it also is a margin lever, right? So to that extent, I think betting on the right platforms and deploying it in the right way, can be a tailwind. And obviously it will require investments both in terms of R&D and as well as in talent. And we need to do that, and that will probably be of a different nature than what it has been in the past. But if you do it well, I think it'll be good for margins.